Hello.
All right, so now I have half of the audience here. I hope everybody had tea. Yes, no, maybe? Now can we hear something? Can my Minoji, Mumbaikars, can we hear? Woo! Oh my God, I got somebody from my company like, whoa, really. All right, thank you so much guys for joining on Back on Time. To some who came. So now moving ahead, now we have some enthusiastic speakers with the session, I can say, because without me calling off the names and very politely coming and sitting, and when the guests are not ready. No worries. So let's now start with the regulatory and advocacy discussions on AIFs. For them, may I please call on stage, as they are already on the stage, can we have a round of applause in together for Divaspati Singh, partner Khaitan Company. Whoa! And then we have Leelavathi Naidu, partner IC Legal, moderator again. And then we have on the stage Bhavin Jatania, Head Products, IIFL Assist Management. Everybody! Then we have Shikha Bagai, Managing Director, India and Mauritius, Vistra Group. Come on everyone, make some noise. Let's have a competition between two females and two males here. Let's see who wins now. Yay! Thank you. Over to you, ladies and gentlemen. Are we going good?
Absolutely rocking.
Can we start?
Yes.
All right, great. Thank you.
Good afternoon, everyone. Thank you for joining us today for the regulatory and the advocacy discussion. Alternative investment funds today are standing at a stage where mutual funds were in 2009, right after the Lehman crisis. Today, we have a very interesting set of panelists with us today. Today, we'll be discussing and dwelling on the key regulatory issues and how regulatory conducive the environment is for the AIFs to grow and become the mainstreaming of alternative investment funds. We'll begin with Bhavin from the business side. Bhavin, recently there were a lot of circulars in terms of uniforming the private placement memorandum so that it's easier for SEBI to have a look at the document and clean it fast. And then you had merchant banker's certificate. Do you think as a business it is fast-tracked the approval process for you, or what's your view about it?
Thanks, Leela. I think to briefly give you a sense of what we are seeing as business in terms of the various regulatory changes that are coming about. I think, of course, the regulators are taking note of the size and the growth of the AIF industry, and accordingly, they are trying to keep pace in terms of regulations and additional requirements that keep coming in. In some cases, it has had a great effect in terms of improving governance structures. And in some cases, there's a lot to be done in terms of ensuring that the regulation meets the intended target. And you mentioned the appointment of merchant bankers, and that's a great example. So the understanding and the belief that we had is with the appointment of merchant bankers, we would have an independent set of eyes to look at the fund documents. We'll have a great amount of standardization coming in. And the expectation from an industry standpoint was that this will help us improve turnaround times and improve the launch timelines when it comes to funds. As with all things, I think in the initial issues, initial rollout and implementation, there have been a few teething issues. But my sense is with time, with merchant bankers also understanding their role, SEBI also coming out with clarifications, I think in the times to come, we should see a scenario where launches become faster, turnaround times improve. And I think the intent, if you look at it, is very similar to what SEBI has done with IPOs. When you had merchant bankers, continuously we are seeing across an effort to reduce times. And I hope that is the situation at which we migrate to also at a future point in time.
Thanks, Bhavin. Just as a follow-on question, Shikha, for every application that we go to SEBI nowadays, along with merchant banker certificate, there's an additional due diligence certificate which you as a trustee sign over and above what the merchant banker submits. Plus you have overseas investment. Again, the trustees submit a lot of due diligence certificates. Do you think adding of role and responsibilities additionally on the trustees to look into the investment side and confirming that the investment managers have done their job is easing your life in any way as a trustee, or adding more to your due diligence that you have been doing all this while?
See, I would say that alternates by structure are more KYC intense. They should be because of the strategies and all of that. So in that sense, they need to go through scrutiny that they need to go through. We also see some amount of, these issues are not only with SEBI. To be honest, we see them even with the Mauritius regulator and all of that. The delays are a part of regulatory frameworks unless you have permanent structures like VCC and all where they are defined differently. I think probably what we could do better on is some amount of understanding and the whole rollover in terms of, you know, where do you need to go in depth into KYC? Where do you have a professional, sophisticated investor? And some kind of a checklist that comes in that can be processed faster. I mean, I would say that in that sense, I don't think SEBI also ever imagined that the flow of AIFs would be what it is. And to my mind, at the level of applications, there is some very simple problems like a manpower issue, very simple. But then there is also an undefined kind of a thing, you know. We don't have checklists. We don't know what you're really asking for. Where is the KYC to be in depth? Where can it not be? So I guess all of that will streamline as we go along. And the use of tech is, of course.
Yeah. Thank you, Shikha. We'll move to another persistent issue that industry was always facing a year and a half back, which is the co-investment. While SEBI came up with the co-investment circular and regulations, believing that a co-investment portfolio manager will resolve all the co-investment issues in the industry. Divas, over to you. Where do you think there are still some teething issues persisting in the co-investment structure which are already existing, and do you think the new regulations have eased out the life for the Cat 1 and the Cat 2 players?
Yep. So I think it'll be important to take a step back to understand why this regime was required in the first place. I think what really happened until 2019-20 was that when fund managers would have co-investment as an option, they would at least be able to rely on the investment advisory regulations or the PMS regulations to put in place a construct so that they're able to charge fees, carry, and a lot of these aspects. PMS regulations got amended in 2019 to effectively say that you can't really have discretionary or non-discretionary accounts, and they put limitations in terms of unlisted securities. There was an informal guidance by SEBI on investment advisor regulations also around unlisted securities. So there was an ask by the industry that there needs to be a formal framework which will facilitate co-investment. Now what came out from the other side was a universe that this is co-investment and this is the only framework under which co-investments could happen. Obviously that led to a lot of ambiguities and a lot of issues, because what has been defined in that framework is co-investment can only be offered to manager, sponsor, and investors of the AIF. So is the intention that co-investment cannot be offered to outside investors? A lot of time fund managers need to offer co-investments to strategic players, people of strategic importance, large investors who are coming in simultaneously. So that gets left out in this framework. Even the entire exit process, the way it's been defined, that co-investors need to exit simultaneously with the entire co-investment. Now that again creates issues because the investment horizon of a fund is very different from the investment horizon of, say, a family office or a long-term institutional investor. Because the fund has a finite life, the fund will be wound up in 7 years, 9 years, 10 years, while a family office may sit forever until the company goes in for a listing. If it's, you know, a mid-stage investment, they may be happy to wait it out. So that is one issue which has come to fore. And lastly, I think they've also somewhere mentioned that from an advice standpoint, they've put a limitation on the fund manager from advising any other player so far as investments in the same portfolio company are concerned. Now, this construct has been in place since a very, very long time in terms of co-investment structures. You have overseas fundraise, whether in Mauritius or GIFT or wherever else, and you have a domestic fund, and both of these funds invest in parallel. And it's sort of managed and advised by the same team. So that has put, you know, a spiral in co-investment structures, has put a regulatory ambiguity. Now the ask of the industry has always been the same, to kind of clarify a lot of these issues so that there is no technical violation tomorrow in the future, because SEBI is also becoming, you know, going on an overdrive mode when it comes to their investigations and penalizing people. So somewhere a lot of these points will need to be clarified for the industry to function seamlessly and comfortably without the fear of a hanging sword on their neck.
Thanks, Divas, for this. While Divas raised a very important point, which is clarity of regulation is very important. There have been recently a lot of consultation papers which started floating around. Bhavin, recently there was a consultation paper on the valuation policy which said that the funds have to move to the IPEV model, which is an international driven model. What's your view? Like one size fits all approach will work from SEBI, or do you think there are complications around it, and what's your advocacy point on it?
So I think again valuation is one issue where probably we are behind in terms of coming up with a clarification. And if you see how we've gone about it, we first had performance benchmarking circulars and requirements for asset managers, and then we are coming up with guidelines on valuation. Whereas in an idealistic scenario, it should be the other way around. You should have clarity on valuation and then go and do performance benchmarking. But to take your point on valuation, I think it's very important for us to understand that under the alternative industry, the various type of investments that are being administered and managed cannot be just bucketed under a broad guideline used internationally, because when you look at it under the alternative industry, we have multiple asset classes which are very, very diverse in nature. So you have a private equity investment, you have a credit investment, you have an InvIT, you have a real estate investment. So the ideal way of doing this perhaps is to have methods and systems that could be prescribed, and they don't need to be restrictive, they need to be exhaustive, and then you can leave it to the asset manager to pick the most appropriate method. And I think the other bit that has already been followed in practice is the practice of having an independent valuer. Now, if you have an independent valuer, I think there is massive merit in having that exchange of information between the asset manager and the independent valuer, the asset manager justifying or explaining the method that they've used, and the independent valuer certifying it. So that, to my mind, is the best combination by which we can take this forward. But I think it helps if you, for the various sub-asset classes and the diverse categories that we are managing today as an industry, have a set of rules or have a set of methods which managers can rely on.
Thank you, Bhavin, for this. Which rightfully said so, because our private placement memorandum are so crisp that you don't end up disclosing actual valuation policy. So I think that's a major concern that SEBI has been facing around, which brings us to the next point. Divas, as I rightfully said, that consultation papers have come out. Do you think when we initially started, because I remember when I moved from mutual fund to an AIF, I was so happy because there were just 3 circulars to monitor and less compliances to do. But now with going overboard, do you think SEBI is going overboard in terms of the consultation papers and the circulars that are coming? Because every month you see a new regime and you take a step back to decide, okay, the type of strategy that you're deciding whether it's going to work or not. Do you think SEBI is going overboard, or do you think it's the need of the time because we have grown so much that we need to now slow down our pace?
So the way I see it, and I hope we're following Chatham House rules and what is said in this room stays in this room. See, the AIF as a regime was launched in 2012. It was intended to be a light touch regime for larger investors to grow the entire asset class in India. Before that, we had the VCF regulations, which were very finite in its scope. Now, when you came out with the regime, and obviously in the last 10 years, the industry, everybody is talking about that the industry has grown manifold. We're talking about something, and maybe Aditya will have a better sense of that number, but somewhere the overall size of the industry is close to 3 lakh crore.
6 lakh crores now.
Yeah, well, double of that. So maybe the regulator is a little concerned in terms of whether what is happening is right. Do they need to look into the growth aspects of the industry? Do they need to kind of be prescriptive around certain aspects? But the way I see it is the industry has grown because it was left the freedom and the space to expand its wings and grow to where it's risen right now. If we start over-articulating on the regulations, being over-prescriptive in terms of what can be done and what can't be done, and start comparing this with the mutual fund industry, which to my mind is absolutely bizarre, because somebody with $500 in their pocket can open a mutual fund account, but for an AIF, you need at least a 1 crore minimum commitment, which is a completely different asset class. If you see some of the recent consultative papers also, they keep drawing a parallel that this is what happens in mutual fund, and hence, perhaps this is what should also happen on the AIF industry. I think the moment we start going down that path, maybe it will stifle the growth of the industry right now. What is grown till now is really private equity, venture capital. The other asset classes are still to unfurl, right? India has a massive gap on the credit side. We are a fairly under-penetrated economy when it comes to credit. Is SEBI doing enough for the growth of that asset class within the overall AIF ecosystem? Maybe not. So we rather focus on those productive aspects than to over-articulate and be over-prescriptive. That is kind of my view.
Rightfully said, so Divas. But there's one more point to look at it is SEBI recently, why is SEBI coming up with so many regulations? Because they're seeing a lot of gaps when they go for SEBI inspections. I'm sure many players over here would have seen in the last 3 years, even during the COVID, there has been splurge in the amount of inspections that are happening around. Shikha, as per you as a trustee, what have you seen in the recent SEBI inspection where SEBI has been coming up and asking you questions in terms of fiduciary role that you're playing, and what's your feedback to the industry as a whole as to exactly how should the processes and the corporate governance be set up?
See, where I see a fundamental dissonance is in the segregation of roles. We have to be clear that trustee appoints the investment manager, but trustee never enters the domain of asset management. It is the asset manager that manages the whole asset. Also, the kind of investors that you have are professional, sophisticated investors. A lot of time, these people come through your wealth advisory routes, and they are very married to the investment manager. So suddenly, if things are, say a tenor has lapsed or something is not working fine, you cannot suddenly not be clear about who's handling what and just put blind liability on everybody around and debar people from the markets and, you know, through punitive actions. And I think that's where we have a fundamental dissonance. From regulators and from stakeholders end to understand that an investment manager is supposed to run the investment management operations. One fine day, if you ask trustee to step in, the trustee cannot suddenly undertake the investment management role or suddenly just fire the investment manager to say that you are not doing your job. It doesn't work that way. So I think that's one principle. Even the kind of inspection reports that we are seeing or the issues that we are seeing on winding up, everything is boiling down to a fundamental lack of clarity to say who's running the asset management and who's running the monitoring and compliance, and that you cannot just create fungibility when you want and segregate when you want. So that is one piece. And the second piece also, I would say there are so many asset managers here is with reference to basic information. As a market, we've always had not too much respect for information, whereas as a market, we've always been, information asymmetry has been a very large theme for our markets. So in a scenario where the shops are not so geared up or they do not respect the need to give that information, you cannot again thrust a blind liability on somebody who's in a monitoring and compliance role because that person doesn't have the information. So I think there are some fundamental issues where the responsibility casting is really not adequate. And considering the kind of investors we have, we do need, if we have just that fundamental clarity, things would be a lot better. So winding up regulations, for instance, so many inspections, we are just seeing blind responsibility casting to say the tenor has lapsed in VCFs and you have not wound up. But then you cannot suddenly step in the investment manager's role and say, or you cannot have a punitive action just because the fund has, when the winding up was never thought through in the regulations themselves. There's no framework for winding up. We haven't described, we haven't defined all of those. So the only place where I think, say that there is a need to do is that we are evolving as an industry. It is okay for us to evolve as an industry, but then would everything be through punitive orders? Or would we evolve together between the regulator, investment manager, and rest of the people who are supporting that ecosystem?
Thanks, Shikha, for this. Taking a follow-on clue from what Shikha just said, winding up is one of the most teething issues that we are facing across all the closed-ended schemes that were launched initially. In fact, the data which recently SEBI released, it says there are around 3,000 crore worth 13 schemes maturing in 23-24, and there are 43 schemes worth 14,000 crore which maturing in 24-25, which is a huge number in terms of the industry. Bhavin, as a business, what are the issues that you are facing in terms of winding up, and what is the feedback from the investors? Because yes, it's a sophisticated investor, but even everybody is concerned about their money, right? So what are the issues that you are facing in terms of business and handling the relationship with the investors?
I'm glad you brought that up, Leela, because as you said, that's pretty much one of the biggest issues that we are facing collectively as an industry. And I think there are a few things that we need to understand and appreciate. Ever since the start of the regulation, this is probably the first set of funds or the first time that we as an industry are getting into that stage where we are liquidating funds and returning capital to investors. So a lot of the theory that we had set in place some time back is now getting tested. And probably there would have been no more extreme time frame to test this. You know, the way in which markets have been over the last couple of years, the dip in liquidity that you've seen, COVID disrupted volumes, disrupted activity. So I think it's very, very important to have a more practical mindset in terms of approaching liquidation. More so given the fact that as an investment manager, there is a fiduciary responsibility on me to try and get the best price of the asset that I'm holding for my investors. If there is a clear line divided in terms of saying by X date I have to sell, I don't think that benefits anybody. It doesn't benefit the investor, it doesn't benefit the intermediary, it doesn't benefit the asset manager. So I think there is a lot of, I would say, consultation needed when it comes to particularly looking at market scenarios like this. And I think in part, probably a bit too late, if you ask me personally in my view, with the consultation papers, we are seeing that effort. And I think what we've seen is probably the tip of the iceberg in terms of what needs to be done. There's a lot that needs to go through in terms of thinking, looking at various implications from a tax standpoint, from an investor parity standpoint. So that is something that perhaps, from a regulatory landscape, needs to be more proactive, needs to be more consultative, particularly at this point in time where you have the first batch of funds which are coming out and facing this issue. And would love to see more proactiveness from the regulatory bodies in appreciating the challenges that everybody across is facing and accommodating them to the best possible way.
Yeah, I think SEBI heard you, Bhavin. They came up with a consultation paper. So your view on it, like is it helpful? How do you rate it, 1 to 5? Is it excellent? Excellent being the score, and what are your views on it?
Well, I'll just follow up from what Bhavin also mentioned. See, SEBI's entire motto and the preamble of the SEBI Act was investor protection and the growth of the capital market. What has been happening right now is very, very prescriptive sort of behavior that I have decided the term of the fund should end, and it should end specifically at this point in time. Irrespective of whose money is at stake, whether the investors are in agreement, in disagreement, a lot of those things have been, kept aside. I would rather say that it's the money of the investors. They should be paramount. Their interest should be paramount. They are the ones who should decide. Today, you could put a higher threshold in terms of what really happens if your original term has come to an end beyond the 2 stipulated years extension. You can put a higher threshold, let the investors decide whether they are comfortable with a further extension beyond what was stipulated, or they wish to wind up the fund as is various basis within a defined time period. There, as a regulator, they can't sit on a prescriptive capacity to say that, if the regulations say that this term should end, it should end exactly at that point in time. Even the consultative paper which has come out, it stipulates that at the end of the term, the only possible scenario is setting up kind of a continuation fund and flipping these assets there with a possibility of, having a third-party valuation which is achieved by trying to get 25% of your assets transferred to someone and achieving a third-party independent valuation to that extent. I mean, much would really depend on what these assets are, what is that particular asset class. Today, we've seen a lot of real estate funds which are stuck towards the end of their fund life because a couple of assets are in litigation with the promoters. Some assets are under IBC. Will the same assets be able to go through this particular circular? Will not. There are some private equity VC assets which are stuck because of lack of liquidity. Like Bhavin also mentioned, we are sitting in a very peculiar time. It's not as easy to find liquidity for these assets. Right? So it cannot be a straight up cookie cutter kind of a solution that this is the solution and you implement it in every possible scenario. You have to let the fund manager decide along with the investors what is right for that particular asset class and what should be done. And I don't think SEBI should go down the path of prescribing what should really happen at the end of the term. I mean, it's been 10 years since AIFs have come into the picture. And now since we're seeing a lot of these end of fund life issues, this is the time when secondary funds, this is the time when continuation funds would grow. And if we become prescriptive, it'll be a death knell to the entire growth of this particular asset class.
Absolutely. Thanks, Divas, for this. We have come to the end of our session. We'll have one quick fireside chat with our panelists to see the fun side of theirs. Shikha, setting up a fund in GIFT City and in India, what would you rate?
See, IFSC, the regulations I think are very good. We really don't have a regulation issue in IFSC. Also, IFSC has to be looked at differently in the sense that it is competing with other IFSCs. It is a Mauritius or a Singapore. Of course, we are waiting for more permanent structures like VCCs and all of that. But otherwise, there is a time issue, but the absorption, the whole absorption of comments, the rollout in terms of the responses is very fast. So in that sense, I think regulator gets very high. I mean, it's moving well. The issue in IFSC is that of volume, which is a question of time. This whole set of people, investment managers are a conservative set of people. They will first, it takes the time that it takes for people to completely trust your feeder funds into a jurisdiction. So we'll see the growth along the way, I think.
Yeah, thanks, Divas. One ask from the regulator.
I think just flipping the entire regime on its head, instead of regulating funds, you regulate fund managers, the way IFSC has done, the way Singapore does, the way DIFC, ADGM does. Just regulate the fund manager and let the fund be to the best understanding of the fund manager and the commercial requirements.
Okay. Bhavin, a date with Nirmala Sitharaman Vaishya is allowing you a Cat 3 pass-through and Deepika Padukone. What will you choose? You're business guy. I should ask you this, right? Like, what will you choose?
The best for the last. Pass through over anything else.
Okay. Thank you so much. You've been a lovely audience. Any Q&A, we are open for discussions. Yes.
All right, thank you so much. It was an amazing session. You want to go for Q&A or should we start? Okay.
Thank you.
Just that what is said here stays in this room.
Yeah. And we had to cut short few things because Aditya said everybody is hungry.
Thank you,
Please,
Aditya. I just need to escape to gift now.
That was a timely reminder.
So, Shikha ma'am, this question is to you. So in many countries, the trustees are also doing the shadow accounting and shadow NAV process to make sure what the funds are performing. So are you doing something here in India, or
Yes.
where is your scope so far is lying for the Indian and GIFT City funds?
Yeah, so you're allowed to do both, and we have a large fund services practice where we do the NAVs. We also do shadow NAVs, yeah.
Okay.
One more.
Anyone?
Yeah, we have.
Good afternoon. My question is for Bhavin Bhai. There is a lot of talk about, bad loan bank. KKR co-founder has also mentioned and government is also working. Now considering the AIF field, which is growing very heavily and they are coming with lot of innovative product, anything happening in AIF field for, say, bad loan AIF kind of things?
It's a great question. I think the industry and the regulatory bodies also created the special sits category to exactly address that. But as we've been talking, a lot of regulatory reform and changes are probably not seeing enough quick execution in terms of putting them into ideas. So, I think there is enough potential. There's massive merit for a category like that to function and prosper. Hopefully in the times to come, we see some action and some flows coming in there as well.
Just to add to that, with Special Situations Fund, there were a lot of regulatory changes expected in the RBI because it's a special situation, right? It's a bad loan. You need to go back and invoke the bad loan as a participant. So these regulations are expected to come over a period of time. Till such time, we're just waiting and watching for these funds to grow. Okay, thank you.
Okay. All right. So thank you so much. Now, may I please call on stage the Saturday partner over here, Price Warehouse and Co. May I please request everyone a big round of applause over them from LLP Company. We'd like to hand over a small token of appreciation from our side. All right, was going that way, ladies and ladies first. See, ma'am, you got the one. a time to capture some important pictures over here.
Thank you. Thank you, everyone.